We are now seeing a drastic shift in sentiment. In the beginning part of 2022, everybody said that the Federal Reserve Bank needs to get aggressive to fight inflation. Now it's the opposite. People are saying that the Federal Reserve Bank needs to stop raising interest rates and they need to stop fighting inflation because they are going to trigger a global recession. We have the United Nations saying this, we have notable investors saying this, and we have big institutions saying this. The issue is that when the Federal Reserve Bank raises interest rates to fight inflation, it makes borrowing money more expensive, it slows down the economy, and it hurts asset prices. And in this economic state that we're in right now, where we're already seeing asset prices get hurt, we're already seeing the housing market get hurt, we're already seeing businesses get hurt, we're already seeing layoffs happen, the more aggressive that the Federal Reserve Bank is, the more that they raise interest rates, the more our economy will get hurt, the more we'll be pushed not just into a United States recession, but into a global recession. We could face stagflation, and this could hurt our entire global economy. The problem isn't the Federal Reserve Bank raising interest rates, because that's something that they have to do now in order to combat all the inflation that the Federal Reserve Bank created over the last number of years. The problem, in addition to the Fed, is DEBT, debt. We are facing a debt crisis, not just in the United States, but around the world, because so many entities are reliant on cheap debt. We have a global debt crisis where right now the world has more debt than we've ever seen before. Our national debt levels are at the highest levels we've ever seen before. Our household debt levels are at the highest levels we've ever seen before. Our corporate debt levels are at the highest levels we've ever seen before. From the global economy to individual people, we have more debt out there than ever before. And the problem is that after 2008, we've seen next to 0% interest rates. We've seen some of the lowest interest rates ever after the 2008 crash. And then we started to see interest rates start to go up before 2019, but then came 2020 and then interest rates went even lower. So we have this whole world, from people to businesses to whole countries, that have been solely reliant on low interest rates, cheap debt, and pretty much free money. And now that we're facing the consequence of this, which is high inflation, we're seeing now the pain of fighting this high inflation, which is raising interest rates. So now we're starting to raise interest rates. We're seeing mortgage rates go up to near 7% now. We're seeing borrowing money for businesses go up. We're seeing the prices of just borrowing money in general rise. And this does a couple things. One, it makes it much more expensive for people and businesses and countries to go out and borrow more money. And it also makes it very expensive for people, businesses, and countries to serve the debt that they already have. Your 30-year mortgage rate, luckily, hopefully, is a fixed rate mortgage. I know we are seeing a big rise in adjustable rate mortgages, but for most people in the United States right now, if you get a fixed rate mortgage, you don't have to worry about raising interest rates. But not all debt is fixed rate. Actually, a lot of debts, most debts, are not fixed rates. They change every year, or they change every few years, or they change every 5 years. And so now we have people and entities like the United States government, which has the highest debt levels ever. And a year ago, Janet Yellen, who was our Treasury Secretary, was saying that we don't need to worry about our national debt levels breaking new record highs because the cost of servicing the debt is super cheap. Mortgage rates were very low 1 year ago. Interest rates were very low 12 months ago. And so the cost of servicing $30 trillion worth of national debt wasn't that bad because interest rates were so cheap. But now we have even more debt, and the cost of servicing that debt is many multiples now today more than what it was 12 months ago. And so the cost of servicing our national debt, the cost of servicing business debt, the cost of servicing a lot of consumer debt, if you have credit card debt, your payments are going up, even if your balance isn't going up, because the cost of servicing the debt due to interest rates is rising at the fastest rate we have ever seen. I mean, mortgage rates have more than doubled now in the last 8 months. Now, I know what you're thinking. What does this random guy on YouTube know? Well, let's dig a little bit deeper. There's been this big growth of something called zombie companies. There's been a number of articles written about zombie companies recently. And the way that Goldman Sachs describes zombie companies is a zombie company is a company that doesn't have enough profits to service their debts. And so a zombie company is a company that has been reliant on outside money, debt, investment money, in order to continue surviving. And now the interest rates are going up. These companies have to pay more money to service their debts. And so we have about 300 or so zombie companies listed on our stock market. Publicly traded companies. Some of these are multi-billion-dollar companies which are not making enough money from their profits to even just pay off their debts. And so the concern here is now the interest rates continue to rise, and the Federal Reserve Bank is going to meet again in the early part of November to discuss raising interest rates again. And even if they don't raise interest rates very aggressively, they say that they will, they say that they need to, and they say that they're going to continue doing that. But even if they don't raise interest rates, we'll just talk about hypothetically here. Well, that still means that the cost of servicing your debts now is significantly more expensive than it was 12 months ago. And so what the concern is for all these zombie companies is you have dozens and dozens, hundreds of companies that aren't making enough money to continue paying off their debts. And over the next 6 to 12 months, as these costs start to pile up, you're going to see more bankruptcies, you're going to see more mergers and acquisitions because these companies are not going to be able to survive, and that's going to mean layoffs. That's going to mean businesses getting hurt. And this is where you have all these entities sounding the alarm saying, Federal Reserve Bank, stop raising interest rates. Stop trying to fight inflation. Let inflation do its thing. We can't cause a recession. But this is where now the Federal Reserve Bank is between a rock and a hard place where they got to decide, what do we want? Do we want to fight inflation or do we want to fight the slowing recession? I've been talking about this for more than a year now, probably 18 months now, that this was going to happen, and we're seeing it happen right in front of us now. If you've been subscribed to my channel, I've talked about this exact same thing countless times, where what are you going to fight? You can't fight both at the same time. You can either fight high inflation or you can fight a slowing economy. And up until pretty recently, it has been, we're going to fight inflation because there's no such possibility of an economy slowing because it's so robust. It's so strong. Our economy has such a good foundation that raising interest rates won't affect the economy. We saw the Federal Reserve Bank and we saw Zillow and we saw so many entities say the same thing about the housing market, that our housing market is so strong that raising interest rates wouldn't even slow down the housing market boom. It wouldn't slow down housing market sales. Yet here we are today. Interest rates have gone up and the housing market is slowing down. We've seen home sales slow, we're seeing home prices come down, and now we're starting to see the same thing happen in the economy, which nobody, quote unquote, nobody could have predicted. At least the Federal Reserve Bank and the government could not have predicted this somehow. So they didn't predict that our economy would slow. Now here we are today. Our economy is slowing, but inflation is still high. And this is where now this battle is going to become significantly more important and more valuable and more painful because inflation still needs to come down. Inflation is hurting regular people. It's expensive for you to buy groceries. It's more expensive for you to get a home because the cost of living is so high. It's expensive for you to buy things, while at the same time, the economy is also slowing. We're starting to see job openings fall. We're starting to see more layoffs. We're starting to see businesses struggle. And as this happens, the economy slows down. We see the concerns of a potential financial crisis. We saw what just happened in the United Kingdom. If you don't know what I'm talking about, check out some of my other videos or join Market Briefs, which is my free financial newsletter where every day my team is breaking down what's happening in the top finance and business news into a fun, easy, witty to read email. You can read it in less than 5 minutes every morning. And not only are you going to be up to date on what's happening in the financial markets when it's happening, but it's going to be a fun read. You're going to look forward to reading Market Briefs every morning because we make it super fun and engaging for you as the reader. So if you haven't joined Market Briefs yet, I got the link for you down in the description below. So you have the global economy struggling. We saw what happened in the United Kingdom where they were facing a bond market collapse. The pound was dropping. The pension funds were about to go insolvent. And then they got bailed out by their central bank. Their central bank bailed them out because they didn't want to see the bond market completely collapse. But that bailout creates more inflation. And it was happening at a time where the UK is already facing record high inflation. Just a couple days before this bailout happened, the Bank of England kept talking about how they need to be stern to fight inflation. They don't want to change their fight on inflation. They just want to fight inflation. They're not worried about an economic slowdown. Then the domino tipped. And the Bank of England also changed their mind and they started bailing out their bond market. The question is, will the Federal Reserve Bank do the same thing here? Today, they say that they're going to do whatever it takes to bring inflation down. They're not worried about layoffs. They're not worried about stock prices and real estate prices falling. That's the consequence that we're going to have to pay. But if a domino falls If a bank says that they're near insolvency, if we see something happen to our bond market, if we see something happen to a major institution, that could trigger a big domino effect, and that could then force the Federal Reserve Bank to completely change their stance. And they could say, you know what, we have been fighting inflation up until this point, and inflation has come off their highs, so we're no longer going to fight inflation. Instead, now we're going to focus on the recession. And this is where now it is between a rock and a hard place, because if they do that, if the Federal Reserve Bank changes their mind and they start fighting inflation, well, now the inflation problem gets worse. Now it's more expensive for people to survive. Now we're facing stagflation. Now, how do people afford the cost of living when your salaries are not going to keep up because we're facing a recession, while the prices of things keep going up? Now we're facing a bigger financial crisis than 2008. We're facing another potential depression, and this is where, yes, a recession is painful. It could be worse than 2008 because, well, the cause of a bubble popping, or the impacts of a bubble popping, are relative to the size of the bubble. And today, the size of our bubble is significantly bigger than 2008. Because before 2008, the main bubble was just in the real estate market, but we have similar bubbles. I mean, you've heard people talk about super bubbles in the real estate market, the stock market, and the bond market. And this is where the Federal Reserve Bank is going to have to make their decision. I keep saying between a rock and a hard place, because people don't want to see a recession. We've become immune to pain, where countries and entities around the world don't want to see pain. They don't want to see a slowdown in the markets. They don't want to see a slowdown in their economies. But sometimes, well, not sometimes, but it's a part of the cycle. You're going to have to go through booms and busts. It's the way that the system works. And the Federal Reserve Bank has been trying to desensitize people from pain. That's why we saw all the stimulus happen in 2020 and 2021. That's why we didn't see any sort of foreclosures. We didn't see layoffs that were painful because people were making more money in unemployment than they were when they were working. That's why we didn't see all the issues that could have came with 2020. So we inflated a bigger bubble, but now we have to pay the price for that. And either we pay the price for it now, or we make the bubble bigger and pay a bigger price in the future. And this is, again, what the Federal Reserve Bank is going to have to decide what they want to do. We have more debt than ever before. This debt is based off of our currency, the dollar. And you can't just keep printing dollars out of thin air without somebody paying the price for it. The most expensive kind of money is free money. And in the short term, this free money can create a big boom. Like when the stimulus checks were sent out, in 2020 and 2021, nobody was working, people didn't have jobs, but you saw a big boom at Gucci and Louis Vuitton. These luxury brands were breaking record sales in the middle of a recession. It doesn't make any sense. Well, somebody has to pay the price for that. These things that don't make sense can be weird in the short term, but they will eventually even out and play itself out over the long term. And today, we're starting to see the price of inflation. And as the Fed continues to raise interest rates, these things are going to affect us, not just in the short term, but over the next 6 months, next 12 months, next 18 months. And as these higher interest rates make their way through the economy, as more debt matures and the debt now increases to the higher interest rate payments, you're going to see more and more businesses start to struggle. Maybe even close their doors because they can't service their debts. You're going to see more and more people say, I can't keep affording my credit card debt because my payments keep going up, even though I've been trying so hard to pay off my balance. You're going to see more and more governments start to struggle because they're going to say, we have all this national debt, we're trying to pay it off, but our servicing cost is growing significantly faster than our ability to pay it off. And this is the consequence of loading up on the cheap debt, relying on the cheap debt, and now trying to fight the inflation by getting rid of the cheap debt. We have a global economy, not just people, not just businesses, not just our country, but a global economy that has been so reliant on cheap debt. And now we're going to have to pay the consequences to this. And this is where now the Federal Reserve Bank is working to bring inflation down. The right thing to do is bring inflation down. It comes with consequences. It means people will lose their jobs. It means that we will see a crash in the stock market. It means that we will see real estate prices get hurt. It means that we will see cryptocurrency prices get hurt. But then we'll be able to recover, and then we'll be able to grow back stronger, more sustainable, more productive. But if you just start inflating again, well, now there goes the cheap, the dumb money, the free money, and it starts inflating, and now things are roaring again for the short term until people start to realize that, oh, maybe these dollars don't have the value that I thought they did, and that creates a much bigger downward cycle. This free and cheap money kind of becomes like a drug. When people are injecting heroin, you think, oh, it's not that big of a deal. Yeah, I'm taking a little bit of heroin, I got a little high, but I don't see any bad consequences from it. But then you keep chasing that same high. So now you start injecting more heroin and a little bit more heroin, and still maybe nothing bad has happened to you, and you're like, hey, I got a great high, nothing's wrong, I just keep injecting a little bit more. But that doesn't mean that it's okay. That doesn't mean that it's good for you. Eventually, if you keep increasing your dose, something bad will happen. Maybe you don't see it today, but something bad might happen in 12 months or 18 months, and that's exactly what's going on with our economy and our debts. We have been loading up on debt at the consumer level, at the corporate level, at the household level, at the national level, at the global level. We have been loading up on these cheap debts. And now that these cheap debts are starting to go away, people will have to pay the price for this debt. This is where now the cost of this debt is going to skyrocket. And this is where we're going to see what will ultimately happen over the next 12 to 18 months, which is why you want to be staying up to date on what's happening. Market Briefs will do that for you for free, which is why if you haven't joined Market Briefs yet, I got the link for you down in the description. But this is where you're going to see more opportunities than ever, because 10 years from now, people are going to look back at this time, and some people will become incredibly wealthy, and others will lose everything. And this is where you want to be one of those people that understand what's happening, that we can capitalize on whatever is happening in our economy around us. You want to see the efficiency grow. You want to see the value of the company grow. And as that happens, you get benefited. And in this system, this is how it works. Now you can hate it, you can love it, but the emotions are really irrelevant. The reality is this is what happens day in and day out, and the people that understand this become incredibly wealthy.